On September 30th, MacroWatch warned that tightening liquidity could result in a replay of the 2019 crisis in the repo market, which resulted in the Fed launching a new round of quantitative easing. A month later, the Fed announced that it would end quantitative tightening on December 1st. And on November 12th, Roberto Perli, manager of the Fed's System Open Market account, said in a speech that we probably won't have to wait long until the Fed begins expanding its balance sheet again, or in other words, begins creating more money again. Even after 3.5 years of quantitative tightening, the Fed's total assets still exceed $6.5 trillion, 7 times more than at the end of 2007. This video will first discuss why the Fed believes it's necessary to end QT now to prevent a recurrence of the 2019 repo crisis. Second, it will explain why the Fed is already signaling that it will soon begin creating more money again. And finally, it will estimate just how much more money the Fed may create over the next 2 years. We'll begin by looking at what happened last time in September 2019. Then we'll see where we are today. And finally, we'll consider what's likely to come next. The following chart shows the Fed's total assets from 2003 to the present. The Fed created unprecedented amounts of money following the crisis of 2008 and again during the COVID pandemic. You can see here the first 3 rounds of quantitative easing following the crisis of 2008, then the first round of quantitative tightening, which set off the repo crisis. That was followed by more liquidity injection by the Fed, and then the COVID pandemic resulted in a huge expansion of the Fed's total assets. And then the second round of quantitative tightening took the Fed's total assets back down to where they are now, $6.55 trillion. The Fed created all that money to finance, at low interest rates, the very large increase in government debt during those crises. Or put differently, the Fed monetized the government's debt. You can see after the crisis of 2008, there was a big jump in the government's debt. There were trillion-dollar budget deficits for 4 years in a row at a time when that was unheard of. Then following COVID, total government debt jumped by almost $7 trillion in just 2 years. And in both cases, the Fed monetized part of that increase in debt to hold down interest rates on government bonds. Now, here we're interested in the period just before and after the repo crisis of September 2019, shown in this gray area, and shown more clearly in this chart. The first round of quantitative tightening began in October 2017. Between then and August 2019, the Fed shrank its balance sheet from $4.5 trillion to $3.8 trillion, a reduction of $700 billion, or 16%. This means the Fed destroyed $700 billion during that time, removing money from the financial markets. The following month, the repo crisis occurred. The day the Fed began its September 17th to 18th FOMC meeting that year, insufficient bank reserves in some part of the banking system caused the interest rate in the overnight repo market to shoot up to an intraday peak of 10%, about 4 times above where it should have been. Moreover, problems in the repo market infected the federal funds market, causing the effective federal funds rate to move up to 2.3%, which was outside the Fed's target range of 2 to 2.25%. In other words, a shortage of bank reserves in some part of the banking system caused the Fed to lose control over the interest rate it uses to conduct monetary policy. The interest rate in the repo market is called the Secured Overnight Financing Rate, or SOFR. It's the rate institutions pay to borrow cash in the repo market. These loans are secured with U.S. Treasury collateral. This is the interest rate that spiked. The effective federal funds rate, or EFFR, is the rate banks pay to borrow bank reserves from one another. These loans are unsecured. The EFFR is the main short-term interest rate the Fed targets to implement monetary policy. SOFR, the repo rate, should normally trade below or roughly equal to the effective federal funds rate because SOFR is secured with treasuries, while EFFR loans are not. So when SOFR rises above EFFR, it signals liquidity stress. That's what happened on September 17, 2019, and it happened in a dramatic fashion. This chart shows the gap between SOFR and EFFR. The massive spike on September 17th shows what a true rupture in the funding market looks like. And that's not all. That day, the